Good afternoon, everybody, and thank you for coming to this conference. Um, let's see. I'm just going to show you this slide briefly. This is the Commitment of Traders report as of Friday. You don't have to know very much on it. The only thing, two things I want to point out are as follows. Right here is the open interest in silver, which is about 196,000 contracts. Now, 196,000 contracts means there's a long and a short. So there's 196,000 long contracts, 196,000 short contracts. And the other thing I'm going to point out here is down here, it shows that the 8 largest traders on a net basis, these are the commercial traders, 8 largest traders are short 48%, over 48% of the entire open interest in COMEX silver. And the next largest traders, the 4 largest traders are short 32%. There are thousands of traders in the silver market, and 8 of them are short 48% of the entire COMEX futures market on a net basis. And it's more than that if you take out the spread trades. So I just wanted to go on that chart, just to let you know that there's a short position, or I'm sorry, the open interest, 196,000 contracts. And if you divide that into something that you understand, you take 196,000 contracts, and there's 5,000 contracts in every contract. So 5,000 times 196,511 divided by the day's number of ounces produced in a day is 2,430,000. The short or the open interest is 404 days of world silver production. So that's what the 196,000 contracts represents. And the 404 days is right there. So you can see there's the total open interest in silver in the COMEX futures market. There it is for palladium, platinum, gold. This is cocoa. And down here at the bottom, this is crude oil. There's 28 days open interest in crude oil. And the 8 largest traders are short 7 days, and the 4 largest traders are short 5 days. So you can see there's quite a difference between what the open interest and the short positions are in crude oil versus what they are in the precious metals. Here, the 8 traders, I can't read it, I think it's 194 days. The 8 traders short 194 days, that's the 48%. This green bar is the 8 traders, and it's 48% of this total bar. And here's the 4 largest traders who are short 32%. And the difference between this one and this one is the 5 through 8, the small traders. So you can see the 4 large traders dominated, as they do in all the precious metals. The further down you go, the less the short position becomes of the big 8 traders. Now, okay, like I just said, this is the short position of the 4 and 8 largest traders in all physical commodities compared to total open interest of each commodity in days of world production of the 15 commodities traded on the COMEX. Now go to the next slide. And the next slide is just the 4 precious metals on the right-hand side. I've eliminated everything else because that's what we come to talk about is the precious metals. And here they are. The other thing I've taken out of here, instead of having 404 up here, it's 376, I can't read it. And the reason the number has changed is that you can be long or short, long on the COMEX, short on the COMEX, or you can have a spread trade, which means you're long 1 month and short another. And as far as the COMEX is concerned, when you have a spread trade, you're market neutral. So if you take out all the known market neutral spread trades, the net open interest is shown here. In silver, it's 200 and some days. In gold, it's down to 250, and it's even less here. And in palladium, but you can see that the short position of the big 8 has gone up because the total open interest has changed. So the largest 8 traders in gold are short 55% of the entire COMEX futures market in that precious metal. And these 8 traders trade as one. They all go long at the same time. They all go short at the same time. So the thousands of traders trading against them, it doesn't matter whether they go long or short or whatever, these 8 traders, control the price of all these of silver to the tune of 55%. And palladium is even more egregious. 8 traders are short 60%. 60% of the entire futures market. How is that legal? Why would they let them get away with that? Because the COMEX is designed for them to control the silver and precious metal prices. In palladium, it's 52, and in silver, it's 56. So the precious metals, and I'm just going to go back to this slide one more time. Okay, the precious metals are always nailed to the right-hand side of that chart. It's been that way for 20 years. You look at this chart 20 years ago, this is what it looked like. Okay, the precious metals have always been held short. Let me ask you this question. If the short position in silver of 194 days, the 8 traders, was transferred over to crude oil, which is 7 days, or copper, which is 30-some days. If the short position was suddenly went up to 194, what would the price of copper be? Or crude oil? Crude oil would be like $2 a barrel. Copper would be 10 cents a pound. So you can imagine what the prices of these precious metals would be if this monstrous, gigantic, obscene, and illegal short position wasn't there. And silver analyst Ted Butler, whose work I follow very closely, had this to say about it, and I'm going to read it. Let me make it easy for those who refuse to acknowledge the silver manipulation. Simply explain why 8 traders, mostly domestic and foreign banks, would hold short the equivalent of 60% of the world's annual silver production and 50% of all the silver bullion that exists at prices below the average primary cost of production and nearly 70% below the price levels of 6 years ago. How could such a concentrated short position be explained in legitimate terms? And what would be its purpose? What effect would such a large short position have on the price of any commodity? And how do you see it being resolved if it wasn't permanent? I don't expect any serious answers to such questions, as it appears to be easier to malign the questioner as a conspiracy theorist instead. But I know these questions have never been addressed in a straightforward manner by anyone who denies the silver manipulation. There it is for you. They're all on that chart. They're all on the right-hand side. And there they are again. And like I said, the largest 8 traders, all of them commercial or foreign banks, are short more than 50% of the precious metals in the COMEX futures market. Now, if you take out the 8 traders, I'm just going to go back here. Here's the 8 traders right here. This thing work, there it is. Here's the position of the 8 traders. There's the big 4 there, and the 5 through 8 are the difference between this number and that number. And if you plot it out, which I can do, because if you go back to the first chart I showed you, which was the Commitment of Traders report, it gives you those numbers. And all you have to do is plot them on a graph. And this is what it looked like. The 5 through 8 traders, these here, the first 4, 1, 2, 3, 4, this is the 5 through 8. They're short 14 days, 15, 17, and 18 days. They're short 64 days of world silver production between the 4 of them. That's a fact, comes right from the CFTC. The largest 4 traders are these bars here. Well, I don't know who these people are, but this is Scotiabank, which is at 23. There's JPMorgan at 67. This is mathematically the way it works out when you figure it out. So it's not hard to see who the biggest short is. Now, the other thing, when I was doing these charts this morning with Nick Laird in Australia, who was really unhappy because he had to stop barbecuing because it was Sunday afternoon there, and he had to do these charts. But I included the chart. This is the chart from Friday. Now, here's the chart, what this looked like a year ago. There's the big 4, there's the small 4, and there's the big 4. There's Scotiabank. Scotiabank's right there. And JPMorgan's the number 2 spot. Now, if we go back to this, everybody, I don't know who knows this, but Scotiabank has been trying to peddle their precious metals division now on the sly for over a year. Okay, and they finally made it public in, I don't know, November. But they've been trying to get, Scotiabank came very close to getting blown out in 2016. And they've been trying to sell this pig in a poke since. And what they've been doing is they've been reducing their short position. So they've gone from this, from 60 days or whatever, now down to here. So they're getting out of the market, but what is happening is that JPMorgan has taken over from them, as have the other four smaller traders. If you take a look here, there's 64 days of world silver production there in those four traders. But if you go here, there's only 48 in this one. So they've increased their short position by one third in a year. And JPMorgan's gone from whatever it is, 35 days up to 67. So the short position is still there. JPMorgan runs the show. My title slide said JPMorgan and Scotiabank. That was before I calculated these numbers last night. When I saw these numbers, if I got to change the first slide, I would have, because it's a JPMorgan show all the way. There's what it looked like when I was standing up here this time last year on this day. That's what it looked like. Here's what it looks like today. The market is still managed, but it's a JPMorgan show 100%. I'm just going to go through this briefly. This is called the Bank Participation Report. One day a month, the CFTC publishes not only the Commitment of Traders report, it shows all the traders, it also shows what the banks, just the banks, all the banks in the world are short in the COMEX futures market, and this is silver. Just look at the bottom chart here. This is the short position of the US banks. There's zero, this black line across here. The short position is red, their long position is in blue. You can see that the American banks really weren't, they were here a bit back in 2005, but by this time they were almost out of it. They weren't even in the market. Then all of a sudden in August of 2008, bang. Anybody who's seen the movie The Big Short, right at the end, watching Bear Stearns go under, this is what killed them. The margin calls on their silver and gold short position, and that's what's killing Scotiabank. That's what killed them in 2016, and that's why it's up for sale. So what we're seeing here, this is Bear Stearns. You can see the short position in silver go from almost nothing down to there. And Ted Butler has been following this religiously since, because he knows who that is. And right now they're short about 167 million ounces of silver, but they've got a huge physical silver stash, which I'll get into in a minute. I'm just going to go up here briefly. These charts here, this blue area here, this red area here is this chart down here. So this is the American banks in red that are short, and here's the foreign bank short position and the foreign bank long position in blue. But the thing that's noticed here is there's only this red line here, this red bars. This is 0, this is 5. There are 5 US banks short this amount right down here. There's 22 foreign banks that are short this amount minus their long position. So the other banks are not even players. They've only got a couple of thousand contracts each in the short position in the COMEX futures market. So it's an American show, and I can pretty much guarantee you that JPMorgan owns all of that too. Not all of it, but a very, very good chunk of it. So this bank participation report goes back to 2000. So you're looking at, 18 years of history? So when the banks really weren't involved, but once silver and gold started to take off, they were forced to step in and short the market against everybody who wanted to go long in order to suppress the price, because what would happen to the stock markets, bond markets, currencies, if they allowed them to rise? So there's their footprint right there, and there's where Bear Stearns was taken over by JPM. The other thing I want to point out is the non-US banks. They were in here as well, but basically by this time they were gone. There's almost no blue bars here at all, almost none. And then all of a sudden down they went, bang. What happened there is that Scotiabank, which was Scotia Macata, which was hiding behind the skirts of Scotiabank, was forced to declare its short position as a bank for the first time. So all of a sudden you see Scotiabank, the non-US bank short position blow out. That's all Scotiabank. Now that was up until last year, and as you've seen from the other charts, they've gone from 73 days short position down to 23. So they're getting out of Dodge. And that's a fact. These are the physical inventories in the COMEX as of April the 1st, 2011. At that time, JPMorgan didn't even have a silver vault. They opened it 4 days before May 1st on 2011. And on May 1st, we know what happened. They stepped into the market in Tokyo, and silver was down $6 overnight. But from that date, they have been adding silver more and more and more and more and more and more and more. And right now, as of today, they're at 121 million ounces. All these banks down here, that's Brinks, Scotiabank, HSBC, Delaware, and CNT, these are all these traces down here. But look at JPMorgan go. They actually own another 12 million ounces on top of that, which are being held for them by the other branches because their vault is full in New York. And Ted Butler, who keeps religious track of this and has been doing it for 30 plus years, estimates from the Silver Eagles and the Silver Maple Leafs and the skimming from the SLV ETF that JPMorgan owns another 550 million ounces of silver on top of that. So this just shows you why isn't somebody asking questions about why are they accumulating so much silver? Whereas everybody else is down here. They're a man with a mission, but what that mission is, I don't know. This is GLD. This is the ETF that was started back in early 2000s. This goes from 2007 until Friday. And you'll notice one thing about it is as the gold price, which is the blue line, rose and fell, generally speaking, the contents of GLD rose and fell as well. There was a big gap here. And after it was peaked out here in 2011, it still stayed high, and then, of course, down it went, and it sort of followed the gold price ever since. This rally here in the blue line here, this is what did Scotiabank in 2016. This is where they threw in the towel. But generally speaking, the line follows. I would say it's probably 90%, something like that. That's GLD. Here's SLV. Silver price, even though it dropped here a whole bunch, SLV continued to climb and continued to climb and continued to climb until the drive-by shooting on May 1st, 2011. And then it dropped. It only dropped about 60 million ounces. And it's been going sideways ever since. But look at the price. It's gone from $49 all the way down to where it's sitting today, which is 17. But the amount of silver in SLV has remained fairly constant since. Why? Who owns that silver and what's the purpose? No idea. JPMorgan has been skimming off of that, and that's part of the silver that Ted Butler says they have is the amount, because they're the custodian for SLV and they're the biggest authorized participant. And they've been skimming out. If they hadn't been taking silver out of here by buying SLV's shares and converting it to metal, this number would be up here someplace. But they've been taking silver out of here all along. So if you go back to the beginning, which I'm going to do here, I'm going to go back to this chart. No matter where you look, last year was Scotiabank, for years and years, for decades, was Scotiabank and JPMorgan. But when Scotiabank ran into trouble in 2016 on that price rally in gold and silver, they ended up having to go to the bank, their own bank, said, we need $750 million in margin call money. And the bank says, what for? Well, when they explained it to them, they found out that the liability that their Scotiabank branch was enormous, so they've been trying to dump it since. So when you look at right now, which is what you see, Scotiabank is getting out of Dodge, and their short position's been taken over by JPMorgan Chase and the other 5 smaller banks. And until that changes, nothing changes. The price will remain the same no matter what anybody else tells you, because the short position is where it's at, and as long as the COMEX allows JPMorgan and the other banks to get away with it, that's where silver and gold prices are going to be. Copper Mountain, which had an excellent presentation here, I listened to it just before. Can you imagine what the price of their stock would be if silver and gold were allowed to rise? Or any of the mining companies in here. And of course, all commodities rise with it. And instead of 8,000 people here, there'd be 80,000. So until that day, we can only hope, but that's what's going on in the silver market and the precious metals right now. Thank you all for coming.